So I'll start the presentation right now. Okay. So welcome everyone. We'll be talking about the LP Institute today. Okay. And I'm going to go through the program very quickly. If you have questions, again, put them in the Q&A and we will answer all of your questions at the end. All right. So the LP Institute is the training program and development program for limited partners interested in investing in new and emerging managers. And let me be very clear about this, because if you're a limited partner interested in investing in established managers, first of all, a lot of established managers don't need new limited partners, so it's hard to get into established managers. But it's much easier to invest in them because they've done 2 or 3 or 5 or sometimes even more funds in the past. They have all of the performance data, all of their stuff really, really easy to view and understand. So making a decision to invest in an established manager is a very quantitative decision. When you're investing in new and emerging managers, they just don't have as much track record. They don't have as much data. They don't have as much information at their fingertips, at your fingertips. So it's more of a subjective decision. It can still be quantifiable. There can still be metrics to look at, but it is much more a subjective decision. And the goal of the LP Institute is to help limited partners, large and small, understand how to make the best possible subjective decisions to invest in new and emerging managers, not only for great returns, but to hit whatever other goals and objectives that you may have. You might have DEI goals and objectives. You might have interest in certain segments, right? Whatever your goals and objectives are, we will help you hit them and make good subjective decisions. So let me walk you through. So the program provides an opportunity, first and foremost, to meet amazing peers. Not only are you going to meet limited partners across the spectrum, so you'll meet some small limited partners, some large limited partners, but you're going to spend most of your time with limited partners just like you. So if you're investing $500,000 a year, you'll meet other limited partners doing $500,000 a year investments. If you're investing $20 million a year, you're going to meet other limited partners doing $20 million a year, because we group limited partners by the size of the investments that they're making. And this is proven to be very, very, very effective. You're going to learn and master investing skills, right? So as I mentioned, there's a lot of subjectivity in choosing new and emerging managers. And we're going to cover really the best practices in the industry by people who have made hundreds of emerging manager investments. And they'll share with you what they look for, how to think about things, what are red flags and what are green flags. All of this stuff we will cover. And then obviously the ultimate goal is for you to make great returns. And of course, when you're investing in a volatile asset class like startups, the single best thing you can do is diversify, right? Because it often the startup investing is based on the power law. And there is usually 1 or 2, sometimes 3 companies out of a portfolio of, let's say, 20 or 30 that return the whole fund multiple times. Now, as an angel investor, or if you're investing direct, if you get lucky, maybe you get 1 in 10, 1 in 20, right? But when you start doing venture investing, you're picking managers to do that diversification for you. And it's probably one of the best ways to get returns, period, and certainly in startup investing in general. So it's right now, venture investing has the best returns overall. And when you're just investing in startups, investing in venture can be some of the best. And by the way, within that, right? So within the world of venture investing, new and emerging managers are the top performing segment. So let's talk about the LP Institute in a little bit more detail. So as I mentioned, we're going to help you master venture capital investing. It's going to take a few hours per week for you to do this. Our goal is if you have a good sense of what you're doing, maybe not really a master, it should take 4 to 6 hours. If you really are coming in with not too much knowledge and you got to learn a lot of the basics from scratch, it might take 6 to 10 hours a week, but it should get lower. Our goal is the average is 6 hours. For someone who's really learning everything from scratch, it shouldn't take longer than 10 hours. And if you kind of know what you're doing, it could be as little as 4 hours. Okay, so it's a few hours a week. And you're going to have the following things to help you. There'll be lots of socializing with your peers, right, that we discussed. You're going to get mentoring from top people in the field that are limited partners. We'll also bring in some general partners who are very good at managing limited partners, so you can see the whole spectrum of how to invest in funds from all different sides. You will provide you with written materials and guides to learn on your own, right? Some of which you may know, in which case, you read it, you're like, oh, all right, I know it. And some of you may not know, so you're going to want to read more about it, right? And that's where you get the difference in the time per week. And then you're going to be given actual deals to look at. So we will provide you deals. Other people in the program will provide you deals. There will be a lot of deal flow. And then, it's up to you. Are you looking to look at a lot of deal flow? You can look at a lot of deal flow. If you're only interested in looking at 1 or 2 deals, then you can look at 1 or 2 deals. But you will actually work on real deals in the program. So it's learning by doing, right? So there's a big social component, a learning component, but it's learning by doing. And I want to stress this. So if you're just like, I want to learn, don't do this program. If you're like, I would like to learn by doing, this is a great program for you. So I'm going to, some questions I commonly get asked about the program or that the program helps you answer, right? How does venture capital really work? Okay. A lot of people have a cursory understanding of it. We'll talk through how it works as an LP, but we'll also give you some insights on how it works as a GP. So you can see both sides of the table. Like, you need to know your part as an LP, but it's useful for you to understand how GPs run their business so you can see how you fit in. Okay. What types of returns can you expect, right? As a rule of thumb, the larger firms, they're the average. So let's take a step back, and I'll give you a quick one on this. The median is not where you want to be in VC, right? You want to be what's called in the top quartile, or preferably in the top decile. Top 25%, top 10%. In fact, we're called the decile group because we're shooting for that top decile, right? And that's where you want to be in venture. But the median returns in venture aren't even that bad. So, depending on the vintage year, which affects the returns a lot, the median returns for new and emerging managers can be close to 3x. That's the median, okay? And so the top decile can be 9x right? And then within the top decile, if you get to the top of the top decile, the numbers can be rather staggering, right? So returns really matter. We'll cover all this in the program, but it matters a lot on where the managers you back fit within the spectrum of the top decile, top quartile, medium, bottom quartile, etc. How do you source great managers? Right? So we'll provide you with a lot of deal flow, but once the program's over, we'll continue to provide you with deal flow, but you want to find your own deal flow as well, and we'll help you with all of that. What are the best practices to complete fund due diligence? Right? This is as I was saying in the opening, this is a subjective investment decision. It is not objective. There's definitely some things that you can use to make objective decisions, but they are a lot of subjectivity, and we're going to cover how to think about it, how to do that in an efficient and effective way, given the amount of money that you're investing. Why say given the amount of money that you're investing? When you invest more money, you have access to more diligence because the manager will spend more time with you. When you're investing less money, you have access to less diligence, and we'll cover all of that in the program. How does venture legal work? You'll most likely get an agreement that you don't understand. And this is a big pet peeve of mine. But to some extent, it doesn't matter because there's a few things in that agreement that really matter to limited partners, and everything else is just lawyers trying to make money, right? So you can skip 90% of the things that lawyers want to make. Oh, we got to add this, edge case on an edge case and charge $10,000 to do so. It's like, no, you don't, but they do anyway. It doesn't affect you as a limited partner at all. But there are things like different provisions that really do matter. What are those provisions? Like limited operations mode. How do they affect you as a limited partner? And we'll cover all that in the program and help you through it. Let me cover a little more detail on the program itself. And remember, get your questions into the Q&A. So the program split into two parts. In the first part, we're going to do an orientation, just welcoming everyone, letting everyone get to know each other, covering how the program works, etc. Then we'll go into an overview of venture capital, talk about scouting venture capital firms, and then begin the process of due diligence in part one. People in the program starting in orientation will share deals among each other. All right. So you're going to be very early on beginning to share deals. And by the time you get to venture scouting in roughly the third week of the program, you're going to actually be looking at a lot of deal flow. Potentially you'll have dozens of deals to evaluate, dozens of funds that you can potentially evaluate. And we work to find funds that meet the needs of people in the program. And I want to take a very important step right now and just say something. We interview everybody that's coming into the program. Now, I'm leaving the office next week to go to an LP symposium in Europe. So I won't be able to do all of the interviews, but I have some interview slots right now. And then you must get your interview booked, okay? Because through that interview, we ask you, hey, what types of things are you interested in? And then we go find funds that are high quality that meet your demands or interests. So you must book if you are lucky enough to have gotten that interview, and only about 25% of applicants have been invited to the interviews, please book the interview let us know what you're interested in, and then we will source deal flow for you in the program that you can evaluate. Okay, so please get those interviews scheduled. So this is the first piece of the program. Now we've slowed the program down this time, so you're going to have a little bit more time to get everything done. And then there'll be a break between part 1 and part 2. And the second part of the program, we're going to go through different tools and systems that you can use to evaluate the deals. You're going to go through a process of formally selecting the deals to potentially invest in. Then you're going to look at the legal agreements of those potential investments that you're interested in and consider different flags, positive and negative, about making the investments, because again, this is a very subjective decision compared to investing in established managers. And then we're going to cover everything that you need to do to close. And I believe that almost everybody in the first cohort completed an investment through the program. And some of those investments were opportunities that we brought, but a lot of those were investments that were referred by peers. So you'll be getting opportunities to invest in from peers in the program. Many of those opportunities are fantastic, and we endeavor to provide fantastic opportunities as well. So you will see some of the best deal flow in the market today through the program. I'll cover some of the perks. So obviously, as I've been saying, you're going to meet some really top emerging managers through this program. And finding emerging managers is not the easiest thing to do, right? And our goal is to make that a bit easier for you, as well as to introduce you. So this is going to be a big benefit of the program for you. For people that are not on the larger end of investing, so if you're only able to invest a few $100,000 a year, we have worked with managers to create lower investment packages so that you can get into funds for a $50,000 commitment, which is extremely low. And the way these commitment work is that they're done with capital calls. So usually maybe 25% is called on close. So if you make a $50,000 commitment with a 25% call on close, you might be investing, if it's 20 to 25%, between $10,000 and $12,500 just to get into an opportunity, which is well below market, and it's something special that we put together for people in the LP Institute. In addition, we have a fund to fund, so we are a limited partner, and we are investing in funds at the pace of roughly 1 to 2, maybe even 3 a month. And so I think we slowed down a little bit just because we were busy, but I think we're back at the 2 a month level right now. And so you can co-invest with us. So if you're uncertain about if this is a good thing and you want to rely on someone else to do the heavy lifting, we're doing the heavy lifting. We'll be happy to share with you our insights, and it makes the process a lot easier. So there's co-investment opportunities, not just with us, but there's a lot of other large limited partners in the program. You could co-invest with them as well. So there's not only co-invest with us, but co-invest with others in the program. And we're really going to give you hands-on guidance on how to complete an investment. So you go through all the steps I listed before, and you're going to have people, experts at each step, able to help you with questions, help you with issues that you're unable to resolve, and guide you through a really leading edge process to make the subjective decision to invest in a promising new or emerging manager. And so the program today appeals, and we have had, and so far I can tell you this second enrollment's going very well. We've got angels, we've got high net worth individuals, we got family offices, we got institutional investors. So I'll just give some stats here. In the first program, which just ended, we had, and you can watch the graduation video, and maybe Niels, you could put the link to the LP Institute page in the chat. You can watch the graduation video with lots of testimonials at the LP Institute site. We didn't ask them for testimonials, but everyone's like, "Oh, this is amazing!" So you're going to see large institutions like the IFC, and you're going to see, family offices, all on that graduation video, talking about their experiences and lessons learned in the program. So you don't have to take my word from it. You can just watch them say it. But just to give a sense of scale, so we had 50 people or 50 investors participate, or limited partners, maybe better to say, and participate in the first cohort, which just ended. And collectively, they were going to invest, or are investing, 350 million over the next 12 to 18 months. It's actually a little over 350 million. We're already not all the way done. We're over halfway done on admissions, but we're not done with admissions on cohort 2. And we're over 300 million already. So this cohort will be, again, around 50 participating investors, but it's looking like we're even have more money from those investors to put into new and emerging managers. And, obviously the large institutional investors, we have one institutional investor that's looking at maybe 200 million in the next 12 to 18 months. And then we have all the way down to like 6 figures, right? So there's a spread, and it matches this paradigm. So I'll just cover the dates. We move things back a little bit. We move things back a week. And the reason we move things back a week is people still haven't scheduled their interviews. Okay? So please schedule your interviews. We have over half of the program accepted, but I think I have 40 interviews that we still need to do for maybe 15 slots. So please schedule your interviews. I would really enjoy talking with you, learning about what you're working on, what you're interested in, and seeing if this program's a fit. So we pushed the final deadline out to June 10th. It was June 3rd. And this allows people who are here today to finish their application. So if you haven't applied, we've given you a few extra days, and then please schedule the interview again. We were originally going to start on the 12th. We've got a major event on the 12th as well. Niels, if you could put that in the chat. A good friend of mine, James Courier, runs a fund called NFX. They are an established manager. I strongly recommend that people attend that event. So honestly, it's probably better that everyone goes to that event than we start the program. So we moved it to the 19th. So everyone here can go to the Venture Trailblazers event featuring James Courier of NFX. It's going to be amazing. And then we'll start the program on the 19th because it gives us a little more time to get those 40 interviews done. And then it's going to run through the summer, but there'll be lots of breaks. You're going to have a lot of break time. We're going to run the program so you can do it at your own pace over the summer comfortably, and it's going to end in the fall on September 9th. So you got a nice slow program this summer. You'll be able to learn and while you're at the beach or wherever. And it should be really exciting and fun. It's going to add it's I promise you that this will be one of your more memorable summers because you're going to meet amazing people who are peers as LPs, and you're going to meet amazing people that are GPs really investing and trying to make the world a better place. Um, yeah, so again, you're going to meet peers, learn skills, and make great returns over this summer. The program had an 80 net promoter score, just to give you a sense of scale. That's better than Apple Computer. That's pretty unheard of in the world. We measure the NPS of everything that we do, and we measured the NPS of the program at the end. Just to give you another sense, we asked people, how likely are you to recommend this? Uh, Two people did a 7 or 8, and everybody else was a 9 or 10 out of 10. Okay. So it's a that's a great sign that it's a great program. Okay. So I'm ready now to answer some questions. I see there are 9 questions in the Q&A. Thank you, everyone. This was amazing. Niels is going to come on screen and help with the questions. Hi, Niels.
Hi, Dale. Okay, let's get to it. Quick note, we do need to end on time, so let's try and cover all of these. First question comes from Andreas. He's asking how to deal with underperforming GPs and what options do LPs have to opt out of a fund?
Um, well, okay, there's a couple different ways to split that question up, okay? So, uh, you don't really know if a GP is underperforming until, okay, let me even go a step further. There are underperforming GPs because they're just not doing the work. And that would mean that they're not making investments, they're not sending out their quarterly reports. So that's a pretty serious issue. So if they're not actually doing anything, that's one issue. Then there are underperforming GPs where the returns don't look that good, but in venture capital, there's something called a J curve. So almost every single fund goes negative for some period of time because their fees and expenses to run the fund and the investments aren't getting great markups. And that J curve can last for 3, 4, even 5 years. Okay. So it's very possible you're like, wow, this fund isn't doing good. And you're in year 4, but it's just a matter of time until some things kick through. And maybe it's year 6 and 7 that you start seeing the first positive returns, in 8 and 9 before it gets really great returns. Right. So let's divide those up. Okay. In the case where the manager is truly delinquent in their fiduciary duties, there is something called limited operations mode in the LPA. You should get the LPA, read about limited operations mode, and figure out what your recourses are as an LP. In the case where you're in year 3 or 4 and you're kind of negative returns, I would just say, it's a waiting game. You have to wait. Sadly, I wish it were not the case, but wait a little bit and see how it goes. Now, if you still are impatient, and I would say if you're impatient, you probably shouldn't be an LP, but if you are impatient, what you can do is there are fairly active secondary markets where you can sell your stake, where you can sell your GP stake to other LPs. And if you're still in that negative area, if you're still in the J curve area, you're going to get a pretty big hit. Maybe, the standard is 50% or less. So if you put $100,000 commitment and let's say 50,000 has been called and you want to exit before they're out of the J curve, you might have a 50% haircut. So again, 50% called is 50,000, a 50% haircut, you might be able to sell it for 25,000. I'm just giving ballpark numbers.
Next question comes from Ray Deck. When should one be an LP in a new manager versus just making direct investment decisions on an angel basis?
Look, I think any savvy investor will tell you that you kind of need to do both, right? It's very difficult to get the amount of diversification that you need as an angel, because it's very tough. At that point, you're basically like a VC because you have to be doing the sort of conventional wisdom on angel investing is you need to do about 12 angel investments a year to get to the volume where you're going to get a breakout success, right? So if you're doing anything less than 12, you're not going to make money on your angel investing unless you get lucky. And it does happen that people get lucky, all right? So a better strategy would be to do a smaller number of angel investment deals, and then whatever you don't angel invest with, you put into a fund or two, and then you get the diversification that you need to get the returns by making the investments in the first place.
Exactly. Regina is asking, by when will we know if we've been invited to an interview?
When you get an email from me. So look, we're processing everything right now. We'll probably be able, maybe Niels, could you take an action item just because I don't want to be typing away while talking, but we extended the deadline because we had this event and we have the event next week. We had a lot of people come in for this event. So we gave people an extra few days. So I would say by next Tuesday or Wednesday, you're going to hear one way or another. Hopefully. Thursday at the latest.
Okay. Similarly, Kwanzaa is asking, is
Yeah, you
there...
can't, there's no acceptance. You have to be interviewed. And then after the interview, so let me take a step back on the process here. So you have to complete an application in full. And then our team reviews that, and they you'll get an email either from me or from someone on my team, most likely Emily, and possibly Michelle. So like it's usually me, Emily, and Michelle in that order. You get an email from me, then Emily reminds you, and then Michelle, and that will say, hey, we got to get an interview scheduled. I'll give you a Calendly link. If you don't do the Calendly link, Emily may send a couple reminders, and then Michelle will reach out to schedule it. Once we do the interview, I ask a bunch of questions, 4 questions. We go through everything. I review those questions with the team, and we render an admissions decision to let you in the program. Then at which point you'll get an acceptance email, usually from me, that says, hey, you're accepted. Now you got to reply. So there's a bunch of people that still have not replied to an acceptance email as well. I think, what are we at, Niels? About 13 or 15 people that have been accepted. All you need to do is reply. What? How many?
I can check the exact
Yeah,
number.
it's in that range. It's 13 to 50. So there's like, you just need to reply, okay, and then you're in. So if you get an acceptance email, you also need to reply. Why don't we skip? We'll come back to your questions, Kwanzaa, because there's a bunch in here, so we can go to some other. And if you have other questions, everyone, do me a favor. I see people are talking in the chat, but please put the questions that you have into the Q&A section, because I see when does the pitch for the, okay.
Mm-hmm. So Ramin is wondering if you can briefly compare the LP Institute program with the VC Lab program.
VC Lab is not run by Founder Institute. Just as a clarification, so there's a separate company called Decile Group. So the Founder Institute runs only founder stuff. Founder, how to be a founder, how to run an accelerator to help founders. Anything founder related is the Founder Institute. Anything investor related, building a venture capital firm, being a limited partner, even working in venture capital, that is all done by the Decile Group. I'm the CEO of the Decile Group. My co-founder and friend, Jonathan Greachin, is CEO of Founder Institute. So the LP Institute and the VC Lab program are very different, okay? The VC Lab program will take a manager that is looking to start a venture capital fund and firm, and it will get them to a close on that venture capital fund in roughly 5 months. The average is 5 months. So you go into VC Lab, and 5 months later, you will close on capital for a venture capital fund. It is a very intensive, nose to the grindstone, launch your fund and firm program. It takes easily 25 hours a week, up to 40 hours a week, and you launch a firm and a fund. LP Institute is a program where people interested in being a limited partner and planning to invest in new and emerging managers learn how to do that, but at a much quieter and simpler pace, where they're essentially, covering one topic at a time to get prepared and ready to invest in venture capital funds. So we cover everything from the legal agreements and all of those different things.
You mentioned 350 million commitment by cohort one. Susanna is asking, do we have any sense of the geographic distribution of that money?
Yeah, so the geographic distribution is that we have really people all around the world. It was mostly US, some Europe and some Asia. So I don't know the exact percentages, but it was probably something like 65 to 70% US and then equal split between Europe and Asia. So managers launching funds are happening all around the world. We've tripled the number of venture capital firms operating on the continent of Africa. We've doubled the number of venture capital firms operating in Latin America. And so you're seeing venture capital firms sprouting up everywhere. Limited partners, however, are still concentrated in areas where you traditionally see more wealth. So the United States has a ton of wealth, a ton of people investing in venture. So you see a lot of people here looking to invest more in venture. Europe and Asia, the same. So, they're concentrated pockets of wealth in Europe, concentrated pockets of wealth in Asia. Now, of course, we've had some people from Mexico. We have some people from Latin America. So I don't want to make it seem like we don't have limited partners coming in from other parts of the world, but the majority of the limited partners coming in are in the US, followed by Europe, and Asia. And then, rest of world, Latin America, Africa, Central Asia, et cetera, Middle East are areas where we're seeing, definitely more and more people coming in, but not as many as the others.
Andreas is asking if you can repeat the matching categories for the yearly investment brackets of the LPs.
Yeah. So what we're seeing right now is roughly an equal number of the following people coming in. investors, limited partners coming in that are investing over $10 million a year, including some as high in the hundreds of millions. We got investors coming in the $5 to $10 million a year bracket, in the $1 to $5 million a year bracket, and the under $1 million a year bracket. Now, these are in just investing into new and emerging managers. These limited partners may also have a lot of other money to invest in real estate or private equity and the stock market. So I'm just looking at what these limited partners are investing in new and emerging managers. And that's why you don't see too many that are investing very, very large amounts, because generally speaking, they'll invest more in established managers than they will invest in, let's say, new and emerging managers. Okay, we got some questions from Kwanzaa. And then I want to riff on general. I'll give some tips and tricks in the last few minutes if you keep a time on general investing in venture. But let's get these last two questions. I'll do some general investing tips.
Okay. So all questions are about, do we have any groups investing in Africa? And then additionally, do we have any investing in healthcare and or life sciences?
Yeah, of course. We as I mentioned, we tripled the number of firms investing in Africa, and all segments you can imagine. We have firms investing in healthcare, biotech, crypto, longevity, if you name it. So again, we launched about half of all new manager firms in the world through our VC Lab Accelerator in 2023. So if there's something that people are interested in investing in, like AI as an example, if there were 30 AI firms launched worldwide, we probably launched half of them last year. So that would be 15, just as a hypothetical. Some other questions just came in, Niels.
Yeah. The other question, we covered it. Yes, we do have like green and impact investments as well. When is asking, will the pro and cons of various jurisdictions of the fund be included in the program?
Yeah, we definitely cover jurisdictional decisions. It can be difficult to invest, for example, in Europe. Kind of has a little bit more regulations, a little bit easier in the US, and we'll cover all this stuff and how to there are more rules on how GPs and LPs can interact, let's say, in Europe than there are in the US. There are rules in the US as well. And we'll give kind of a high level overview of that from the perspective of a limited partner. You don't need to know all the stuff that a general partner knows, but you should know enough on how it works from the limited partner perspective.
Mhm.
And there's a question, can I join on behalf of my boss? Here's what I would say. We have team members participate that are managing money as part of an organization. So if you are on a team that's investing money in the venture, absolutely, we've had plenty of team members participate. Okay, so I'd like to talk a little bit about general investing tips and tricks, because that's also part of the topic today. But I also wanted to cover, we had a lot of people interested in the how the Venture Institute works, et cetera. So I wanted to cover that as well. So here's the first thing that I would say about when you're queuing up to make investments into new and emerging managers, and I'll give you a couple things that are common mistakes that we see. At the end of the day, you're going to collect all this data, and there's going to be a lot of things that appear to be objective. Okay. Oh, this person is good because of this, right? But as I said quite a few times throughout this presentation today, at the end of the day, it's a subjective decision to invest in these managers. And one of the biggest mistakes that limited partners can make is that they try to transform a subjective decision into an objective decision. And then they say, well, I'm not going to invest in this manager because, for example, they have a lower so amount of money that they're putting in the fund than someone else. And in reality, like the amount of money that someone puts in a fund does not make one fund better and the other fund worse, right? It's certainly like a data point to try and make a subjective decision more objective, right? But there are people that didn't put a lot of money into funds and had enormous returns. And there are some people that put tons of money into their own fund and made no returns, right? So you've got to be very careful as a limited partner not to confuse or not to try to turn a subjective decision into an objective decision. And so, really, at the end of the day, you are subjectively evaluating with new and emerging managers, can this individual, can this manager execute on their vision in such a way that will generate maximum returns, right? And so, do they have the deal flow? That's kind of a subjective decision, right? Do they have a nose to determine what's a good deal from a bad deal? That's somewhat of a subjective decision as well. Are they going to stick with it for the next 5 years with incredible determination and hustle to make sure the money's deployed and that the companies are helped? That's again a pretty subjective decision. You can look at maybe have they done other things that are hard like this for long periods of time, but you're going to have to make that decision on your own. And so the first tip is again, be careful not to try and turn a subjective decision into an objective decision, right? And once you come to this conclusion, yeah, I think that this manager will in fact execute on the vision that they say they're going after. The second piece of advice that I would give to you is, be careful of paralysis by analysis. So we've seen a lot of people then get stuck in this loop of like, well, maybe I should look a little bit more, or I'm not entirely sure I need to look more. You kind of need to just pull the trigger because what you need to train your gut and your subjective decision making capabilities. And the best way to train your subjective decision making capabilities is to make decisions, right? Indecision doesn't train your decision making capabilities. Indecision thwarts it. So the second and final piece of advice is once you get to that subjective decision, make the decision, right? Maybe it's a yes, maybe it's a no, make it. And frankly, the more yeses you do, the more you're going to train yourself to be a limited partner. We're going to cover all this and more in the program. It was great to see everybody. Remember a few things. One, get your application in if you haven't done it. Two, if you have an invitation to set up a meeting, please set it up. And three, if you've been accepted, reply back to let us know you're in. Thank you, everyone. Have a great day.
Bye, everyone.